All right. Sorry about that, guys. So, perpetual inventory. So, everything that you've learned from periodic inventory, make sure you go ahead and put that aside. Don't forget it because it will be on the exam that you're going to be tested on both methods, periodic and perpetual. Now, the only thing that I want you to recognize is that you need to be able to show me the difference between the periodic and perpetual inventory. Okay? So, of course, we're going to talk about merchandising inventory one more time. All right, so same thing here. This is inventory. However, we're going to take a product or a good. We're going to purchase it with cash, right? We're going to take our cash and convert it into goods. Then we're going to take that goods and we're going to turn around and we're going to sell it and get sales out of it. And then after that, we're going to basically convert our sales into cash. So ultimate goal here is that we're trying to make money. We're going to purchase a product that's already been made and we're going to sell it at a higher price, okay? And usual typical stores that do this are retail and wholesales, okay? We're not focusing on manufacturing. We're not focusing on creating the product. We're focusing about just purchasing a product and, repackage it and sell it at a higher price. Of course, with that, inventory is going to include all of the above. So everything that it is going to take to cost you in order to get the asset to the store. So that can include anything such as your purchase price, sales tax, freight expense, shipping cost, or shipping and handling, right? You also are going to also include any storage fees, anything that takes it to get to your store, okay? But for this class, again, we're only going to be primarily focusing on the purchase price and any freight charges, okay? The only exception is that for sales tax, depending on who the vendor is, and if you, in case for any reasons that you have to take in an emergency and run out and actually physically go to their store location, you may be subject to be taxed for purchasing the inventory item. But most often cases, if it is a true vendor to customer relationship, you should be tax exempt because you're in a legitimate business. So usually you do get tax exempt. But for things like Costco has now been opened out to the public that they are starting to charge sales tax even if you have a business card. So that's the example there. And of course, we talked about the difference between periodic and perpetual, right? We are only going to be focusing on primarily perpetual because we've already learned periodic, right? We learned that during when we're dealing with periodic, it means that you're going to update your inventory every once in a while. So often what happens is at the end of a given period, you often will have a physical count of inventory. So that's at least you'll know how much inventory you still have at the end of a given period. And your only automatic assumption is that if you purchase all these items and you end up with this, your automatic assumption that you sold some along the way. Okay? And the big difference is that we don't really care for how much we keep track of how much items we sell. We only care about how much we purchase and how much that we have at the end of the day by taking the physical inventory count. Whereas perpetual inventory, it literally means constantly, okay? And when we see that it literally means constantly, it means you constantly are going to be updating your inventory, okay? So every purchase that you make, you're going to go ahead and update your inventory. For every sale that you make, you're also going to update your inventory and take out your inventory. So in this case, at any given point in time, you should know how much items you should have at the end of any given time, any day. So with that assumption being there, you're constantly going to be updating your inventory so you know at every single point in time. However, it is also recommended to take a physical count every so and so, just to ensure that when you make your calculations, that you accurately don't miss a sale, or you accidentally don't, or in case of any fraud has happened or things get stolen, yeah, you'd be able to figure that out. Okay, so again, all purchases and all sales are the reason that affects your inventory for Perpetual. Okay. And the biggest difference that we notice here is that when we're talking about periodic inventory, right, we recognize periodic inventory as an expense to the company, right? And therefore, once we're done and we reach our end of the period and we do our physical count, that's when we convert our expense into inventory or an asset. Whereas Perpetual inventory, the day that you buy it, you're going to automatically place it into your inventory. So it's going to be automatically recognized as an asset. Okay, so let's go ahead and take a look at this example here. So again, here, example number 1, here on July 1st, XYZ company purchased 100 toys, costing at $5.65 each, and it's from Toys U, and the freight cost was $100. Record this transaction. So from the little information I talked about previously, what are you going to be journalizing, or how are you going to be journalizing this transaction? You're going to debit your toys. Yes, so everything. So here's one note I want you guys to know. Everything is going to go into inventory. So including every single cost, every freight, everything is going to go into inventory. All right, and in this case, we know specifically what our inventory item is. So therefore, we're going to either debit inventory toys, okay, in parentheses, and it's going to include every single cost. So in this case, we know that it's going to cost me $565 for just the purchase price itself. But I'm also going to include the freight, because that's going to also be in part of my inventory, right? It's going to be included in my cost of goods sold. So in this case, I'm going to clump up my inventory, and I'm also going to clump in my freight expense, because I'm only going to put it into one account. So where are you going to put it all in? You're going to place it all in an inventory. So in this case, this is where I'm going to include my purchase price and my freight expense, and I'm going to place it in inventory. So as you can see here, it's $665 that I'm placing into inventory. I'm including both purchase price, which is $5.65 each at 100 toys. So that's $565 plus $100 freight, giving me a grand total of $665. All right, and then you're going to either pay for it, or you place it on accounts payable. Any questions in regards to this? It's the most simplest concept so far. No? Okay, so now that was all for 7.1. So, of course, with 7.2, when we're dealing with perpetual inventory, we also have to assume that there's going to be returns and allowances. So let's go ahead and dive right into that. So again, little review here. Oftentimes, when we make purchases of inventory, there will be things that go wrong, such as the vendor may have sent you the wrong items. The FedEx or the UPS store decided to just, throw our inventory on our property and break our items. So you can have a possibility of that, broken or even defective items, okay? Other things can be too is like maybe a supplier is cheaper, but they provide the same quality and you prefer them. right? They're easier to deal with. Or it could be down to customer service, right? If you're dealing with a company that doesn't work with you, or you're trying to complain and they do absolutely nothing for you, then of course with customer service, right? You don't want to deal with them. You don't want to work with them. So that is those are the assumptions that you can have a purchase returns and allowances for. And of course, when you're dealing with a vendor, oftentimes vendors want to keep your business because you're probably going to be one of those people who purchase at least thousands, or you buy in bulk, large quantities. So you make up a pretty large portion of their business. So they want to do whatever it is to make sure they keep you satisfied. In order to do that, sometimes it's even unlimited amount of returns or refunds. Sometimes they'll give you full money back guaranteed, or oftentimes they'll give you even additional discounts. All right. So that's pretty much cool when it comes to a vendor to customer relationship, because at the end of the day, they want to keep their brand name as well. If it's their product that you're trying to sell, right, and you sell them a defective product, that the customer, on the other hand, isn't going to want to purchase this product again because of how oftentimes it's defective. So in that case, that's a reason why you want to also ensure that the product that you purchase is good. Okay. Now here's an example here. We're going to practice again making the purchase of inventory. So in this case, on January 1st, you purchase 100 coffee mugs on an account from Cuppies Co. And it cost you $1.25 each. All right. Freight cost you $100. So how am I going to record this transaction?
Debit coffee mug.
Yes, debit coffee mugs. All right, and what else? What's my credit going to be?
Payable.
Yes, because the key word is that you placed it on an account. So again, we also have to recognize that everything is going to go into inventory. So if everything's going to go into inventory, my coffee mugs are going to be there and my accounts payable. How much is my total is going to be into my inventory for the coffee mugs?
225.
Yes. Okay, so we're going to calculate how much my purchase price was. All right, so in this case, it's 100 times $1.25, giving you 125 plus the freight of $100. So that gives you a grand total of $225. Okay. Now, here's where we have to take a look at this. Now, for this case, if on January 5th, I decided that I received the items and I found that 10 of the coffee mugs were broken, okay? And I requested for a full refund for the broken items, and the vendor grants you a full refund. How do I record this transaction?
Accounts payable.
Accounts payable. Yes, we're essentially getting our money back, okay? And what else?
Inventory credit.
Correct. Because where did we place our items in the first place? When we purchased them, where did we place them? We place them into inventory. So therefore, when we're making a return or a refund of an item, you're going to credit your inventory. Okay. So again, it was $1.25 each. Okay. So $1.25 times 10 gives you $12.50. So that's what you're going to be refunding. And that is it. That's as simple as it can be for the purchase, for the returns for this one. Okay? So, because everything is in inventory, when we make a refund or a return, it comes right back out of inventory. Okay? So scenario number 2 now. Okay, on January 5th, you received your items and found that 25 of those coffee mugs were actually the wrong size. you ended up getting extra large cups, okay? And you requested for a refund on the extra large cups, okay? However, the vendor offers you a 20% discount because they said that, well, if you're just selling coffee mugs, right, you could still sell them. Why do you need to return them for, right? They're just extra large cups. It's not like they're the different colors or anything like that. So because they decided to give you a 20% discount because you could still sell those cups at the end of the day, you're also going to accept that 20% discount. So because we're going to we attempt to return, but we're getting a 20% discount, how are you going to journalize this transaction now?
Payable, debit.
Yes, you're going to essentially get your money back again. So we're going to decrease, or we're also going to decrease our liability because we're getting money back. What else?
Inventory credit, 625.
Good. Yes. Okay, because same idea as making the return. Well, where are your coffee mugs? They're in inventory. And in order to take out inventory, you just take it out directly from it. You credit it instead of increasing our, because we're decreasing our inventory. So in this case, everything that goes into inventory, the assumption is everything's going to come out of inventory. Okay? The difference between that and the purchase expenses, because it's not an inventory yet, we have to make a safe assumption that we need to decrease our purchase expense, and we can't just write it off, because the idea of periodic inventory is that we don't know how much our total inventory is until we make our physical count. So therefore, we need to make a contra account to determine to lower our purchase expense. Where in this case, it's already located in inventory. We know where it is. So at the end of the day, no matter where we're at in given time, if we place everything in inventory, the automatic assumption is we're taking it out directly out of inventory. So in this case, yes, we're going to take our total mugs. So again, they cost you $1.25. You're going to times that by 25, and then you're going to also multiply that by the 20% to give you $6.25 each. Okay? And that's it for chapter 7.2. Okay? All right. And of course, when we have the idea of making a purchase returns and allowances, we also get the idea of getting a purchase discount. So in this case, yes, we're going to be taking a look at net and gross method again. We're also going to be taking a look at terms, right? Oftentimes, when we're dealing with our vendors, they generally give us additional discounts or offers because, again, if we're making purchases from them, the whole purpose of terms is to guarantee that the money goes through, right? But in this case, we're looking at a vendor perspective, so they're going to give us a 2% discount if we can pay them in time within 15 days, and if not, then the whole bill is due in 30. Okay, so they give us kind of an incentive to, one, pay them quickly, but also to just guarantee that they get the money. Okay. So with that being said, we're going to be looking at the net method, and we're also going to be looking at the gross method. As we mentioned this before from the previous section in chapter 5, right? We learned that the net method means you're going to take the discount immediately, while in the gross method, we're going to record it as usual, and at time when we pay, we determine whether we made the discount or not. Okay, so in this case, let's go ahead and practice the net method first, since we know this from the previous couple chapters. So in your case, the net method. So on February 1st, you purchase 100 coffee mugs on an account at Cuppies Co., costing you $1.25 each, with a freight cost of $100. terms are 5%, 10, net 30, and you want to record this transaction using the perpetual method. So again, if our original assumption is that we're going to take a discount immediately, how am I going to journalize this?
Accounts payable, debit.
No, you're not returning.
Oh, debit inventory,
Yes, you're going to debit your inventory.
coffee mug.
Yes, which is the coffee mugs.
And then accounts payable.
And then accounts payable. Good. Now, we also have to include the discount. So in this case, the discount is 5%. So you're going to apply the 5% immediately.
From 125, we have to reduce 625.
Correct. Which means you're only going to subject to 218.75, right? Plus the freight. You can't forget the freight. Okay? So then scenario number 1 is, let's say it's now February 9th and you decided to pay Cuppies Co. With a check. And obviously with the terms, right? It's 5%, 15 net, 5%, 10 net 30. So in this case, did I meet my discount period?
Yes.
Yes. So therefore, my assumption is I'm going to pay them. Now, what amount am I going to pay?
$118.75.
218 because you have to include the freight.
Oh yeah.
Okay. Our assumption is we've already took the discount. We don't need to recognize that we got a purchase discount. All we need to recognize is that we've already taken the discount out. So we're just going to pay as usual for whatever it is. Okay? Whatever you claim after taking the discount, that you claim that you're going to pay it on time. Okay? Whereas scenario number 2, let's say it's the same scenario, except this time it's now fast forward. It's February 15th, and you decided to pay Cuppies Co. with a check, and you actually, your terms were 5%, 10, net 30. So you actually missed the discount. Okay? So because you missed the discount, right? That means you don't get that 5% discount. So what are you going to do with that $6.25?
Debit.
What are you, you are going to debit accounts payable because you're making a payment. Good.
And then your coffee mugs.
You're going to debit your coffee mugs for the $6.25 because you have to add it back into inventory because you originally took it out in the first place. Now you got to add it back, and then of course your payment is going to be higher. So again, because you missed the discount period, you're going to owe more money. You're going to owe for the full price of the $225. Okay? And you're going to add back to the inventory. So this one's pretty straightforward. You don't have to deal with any contra accounts. The only account you're dealing with is just inventory and inventory only. So again, everything goes into inventory. Everything comes out of inventory. Okay? So then now we're going to look at the gross method again, just for practice purposes only. So again, even though we were given 5%, 10, net 30, right? How are we going to journalize this?
Debit mugs.
Yes, you're going to debit your coffee mugs, and we're going to do it at full price because we haven't paid them yet. We're just writing down that this is what we owe, right? Now, what if we did make a payment on February 9th? We actually made the discount period. So how are we going to calculate the discount, and where are we going to place this discount?
accounts payable.
So you're going to do accounts payable. Yes, you're going to credit our inventory because we're taking it out from it, right? Because the assumption here is we're going to pay less because we got the discount. We made the discount, period. So therefore, we're going to take that 5% away from our inventory because we actually in reality paid less than what it was supposed to be purchased for. So in this case, yes, you're going to recognize that you're going to decrease the amount that you owe, but you're going to pay less. You're going to pay $218.75 instead. And you're going to decrease your inventory because that's not how much you paid. You didn't pay for the 225, you paid only 218. Okay? And then of course, lastly, if you ended up missing the payment period anyway, it's already straightforward. You already recognize that you owe the full 225, so all you're going to do is just going to pay for the full 225. Okay? Straightforward. All right? And that is it for chapter 7.1 all the way to 7.3. So here's a little course review again. So this time, instead of recognizing our how to journalize our purchases of inventory for periodic, this is how you journalize for perpetual. It's going to be for whatever inventory item it is. So in this case, my inventory item is hats. So there you go. I journalize that it's hats. And how I paid for it will be whatever it tells you you paid for it. And again, everything goes into inventory. So including freight, including tax if there is any. Everything just goes straight to inventory. And of course, we looked at our purchase returns and allowances. So if we did make a return, right, what happens here is we're just going to credit our inventory account. That's it, because that's where we originally placed it. That's where you're going to take it all out from. Okay? And then same thing with the discounts, right? If you have the net method. I'm sorry, am I on this one? Yes, if when you're on the when you're dealing with the gross method or the net method, right? When it's gross, you record it as original, and when if you meet the discount period, you just take it right out of inventory. Same thing and so on and so forth. Okay? So pretty straightforward. You don't have to deal with any other accounts except for the one and only regards to this. Okay? Now I will tell you this. Common practices, or actually, I would say the best way to do this, okay, would be actually doing perpetual. Because not only do you get to ensure the accuracy of your accounting, you can also ensure there's no fraud as well. Because again, if you're going to wait till the end of the period to check up your inventory and make your physical count, your automatic assumption is you sold everything, right? There's no way unless you match your sales to it, which then again that would defeat the purpose of having a periodic inventory if you have to match your sales to it. But another thing too is you should keep track of your inventory. Every time you sell something, you should subtract it from your inventory. It's a better way of managing your inventory in a much more better way, I would say. But again, but there are times where sometimes, you don't care to keep track of those other items, right? For example, you don't sell those items often, so you can care less whether you have it or not. Where perpetual, right? The idea of with perpetual is if you're constantly buying and selling, right? Especially if you're a grocery store, right? Number one thing is you're always constantly buying water. You're constantly selling water. Okay, that's just an example. Right? And if that's the case, then yes, you should keep track of it, because if you're purchasing so much at one time and you're selling so much at one time, your best way to keep track of it should be perpetual. That way you know how much you should have, and it also gives you a guideline of when you should just make another purchase order to buy more inventory. Okay. But again, both of those tracking methods are commonly used between businesses, and they're still used today because it just depends on what product you sell. Okay. So let's go ahead and take a look at our chapter 7.1 to 7.3 periodic purchases exercise, and let's take a look. Okay. So here we have on April 5th, okay, you purchased 1,000 units at $5 each. Freight cost you $100. And here you put it on an account. Terms were given 5%, 10, net 30. So how am I going to journalize this? In this case, I'm not specific on the item I purchased. So my assumption is what? How am I going to journalize this?
Inventory.
Inventory. Good. If you don't know what it is, place it in inventory. But if you do know what it is, try to be as descriptive. Yeah, accurate. Good. Thank you. So inventory. And what was our assumption? How did we pay for it?
Account.
We placed it on an account. Good. Okay. And what is going to be my total value here? What's going to be my total debits and what's going to be my total credits?
5,100.
5,100, because we are assuming that freight is also going to go into inventory. So at the end of the day, your inventory should equal that. Okay. So again, I'm going to also make a note here that I purchased 1,000 units at $5 each. Okay, like that. All right. So then on April 7th, you decided to return 200 damaged units for a full refund. Okay. So, how are we going to journalize this on April 7th?
Accounts payable.
Good. We're going to reduce our liability that we owe, or our bill in this case, right? And then what is our credit going to be? Where are we taking this out from?
Inventory.
Yes, because we're essentially returning our items. So, because we're going to return our items, right? If it costs me $5 each, right? What is going to be my total amount that I'm going to receive back, and how much am I going to be returning?
1,000.
Yes, you're going to return $1,000 back to your or lower your amount that you owe by $1,000, and you're returning each item at $5 each. So in this case, I'm going to also indicate that I returned 200 units at $5 each for okay, actually I'm due full refund. Okay, good. Now, on April 10, right? You purchase an additional 750 units at $5.75 each, freight costing you $75. On an account, terms 5%, 10, net 30. So,
Inventory.
yes, you're going to debit your inventory, and you're going to, what are you going to credit?
Accounts payable.
Accounts payable. So again, this is all standard, straightforward. So I'm going to copy and paste it in here. Okay. And I purchased how many items? I think I did 750 at $5.75 each. Okay. So how much total is going to be my for my inventory?
4,387.50.
4,387.50. Yes, including the freight of what was that? 70
75.
75, yes. So it'd be 4,312.50 plus 75, bringing it to $4,387.50. Okay, good. And we recognize that that's what we did. We purchased it at this amount. Okay. Then on April 15, we decided to return 50 broken units due to shipment for a full refund.
Accounts payable.
Yes, we're going to decrease our accounts payable. So this is April 15, accounts payable. Okay, and we're taking it right out of inventory. Okay, returned 50 units at $5.75 each. Full refund. Okay, so how much am I going to be getting back or reducing the amount I owe, and how much is my inventory?
Give me 287.50.
287.50. 287.50. Okay, good. All right, I know this is tedious, but we're almost there. April 20th, you purchased an additional 200 units at $6 each, with the freight costing you $20 on an account, terms 5%, 10, net 30. So what is going to be my accounts?
Inventory.
So I'm going to go on the next page here. This was April 20th, and we're doing inventory, and we purchased 200 units at $6 each. $6 each. So what is my total amount that is going to cost me? What's my total inventory?
1,220.
1,220, yes, including the freight of $20. Okay. So now that we have that, then on April 22nd, 25 of the units were the wrong color, but you're willing to accept a 20% discount. So how are you going to recognize this one this time?
Be a debit to accounts payable and a credit to inventory for $30.
Okay, good. Yeah, okay, so here, okay, I think it was on the 22nd, good. 22nd, right? We recognize that accounts payable, we're going to reduce it, right? But we're only reducing it by 20%. So we need to make a calculation here. So instead of this right here, we're only returning, was it 50 items? 25 of the units were the wrong color. So 25, we're trying to attempt to return 25 units. Okay, but how much did it cost us? It cost us about $6 each. Okay, but we're not getting a full refund. How much are we actually getting back?
30.
20%, yes. Okay, so let me see. So 25 times 6, right? And then 20% of that gives you $30. Yes, good. All right. And then on the 25th, you decided to purchase an additional 500 units at $6.25 each with a freight cost of $50 on an account. Terms are 5%, 10 net 30. So let's look at this one. So on 425, how are we going to journalize this?
Inventory.
Mm-hmm. On accounts payable.
Accounts payable.
Mm-hmm. And it was 500 units at $1.25. Sorry, $6.25. So therefore, and plus my freight was 50. So what is my total amount of inventory I have here?
3,075.
Good. Okay. All right. And then last but not least, you're going to make a payment. You made a payment for all 4 purchases, write 4 separate checks. So, because we're writing 4 separate checks, let's go ahead and recognize the first one. So, this is for 30. So, what was our first purchase? What was our very first purchase as we made?
1,000 units at $5.
Mm-hmm. Now, we also made a return, right? Okay. So, okay. Now, the question is, did we make the discount or did we not make the discount?
We did not.
We did not, because 10 days from April 5th would be April 15th. So in this case, no, we missed the discount, so we don't even get it. But we do have to pay it in all because it's going to be due anyway. We're already at the end of the month. So in this case, we need to calculate how much accounts payable we actually have for check number 1. Okay? So how am I going to pay my vendor? How do I pay my vendor? I'm paying it with a check, right? So how am I going to record this transaction?
Yeah, debit to accounts payable and a credit for checking?
Correct, right? We need to reduce how much we owe because we no longer owe it anymore. And we are making a payment using a check. So therefore, it's going to come directly out of your checking account. Now, because we made a purchase and we also made a refund, how much is my total accounts payable for my first purchase?
Be 4,100?
4,100, because here, if I originally set that I made a purchase for the full 5,100, and I made a return which reduced my account, right? I refunded my account by 1,000, so therefore I should have a remaining balance of 4,100 for that bill. All right, and this one I'm going to go ahead and indicate that I paid paid for purchase on 4/5, and then comma, check number 1. We'll just say check number 1, okay? Because I didn't give you specifics on what check number to write, okay? Good. Now, our next check that we have to write is going to be for the second purchases, okay? So the second purchase that we made was on the 10th of April, okay? But what else happened besides that? We also made a return on the 15th of April. So in this case, let's look at our accounts. So on the 10th of April, we purchased inventory for the $4,387.50, but we made a return for $2,287.50. So how much do I owe for the second purchases?
4,100.
You also are going to pay another additional 4,100 because here we got here, then we decrease our accounts payable by the 287.50, reducing it to your total amount that you owe to be 4,100. All right, so I'm going to just copy this right here. Okay, and this time instead of purchases on 4/5, it's purchases on 4/10, and this is check number 2, and it's going to be for the total amount of 4,100. Good. All right. And obviously we didn't make the discount period because this is the 10th, right? 10 days after that it's going to be the 20th, so we missed the discount period already. All right. So now the third check is going to be for our next purchases, which is here. We purchased 200 units for $6 on April 20th. Your terms are 5% 10, net 30. Okay. And on the 22nd, we also made a refund for a 20% discount. So how much what am I going to be recording here? Did I make the discount?
Yes.
Yes, you did. Okay. So how am I going to journalize this one this time?
Payable.
Yes, we're going to do accounts payable. Okay. What else? We've got a discount. So what are you going to take that discount away from? What account am I going to recognize for?
Price, well, yeah, from the inventory.
Inventory, yes. You have to take it away from inventory because you're not actually paying the full amount. We're actually paying less. So I also have to recognize that I'm paying them with a check. Okay, so I'm going to go ahead and take a look first. What was my original purchase first? So if I originally purchased on the 20th of April, right? I purchased a total of $12.20. However, I also made a refund, right? So therefore, I decreased my account by $30. So how much can I actually take a discount for off the 5% off of what value am I going to take it off of? Okay, so this one you have to use a lot of brain power. Okay, if I originally purchased my inventory items at $6,
So I'll put a 1,200.
did we have all $1,200? No, we made a refund, or we got a 30%, a 20% discount.
So off of 1190.
$11.90. Good.
Would it be 1190 because that includes the freight, or would it be 1170?
Let me see. 11.90. 1,200. Oh, okay. Yeah. Sorry. 1,200 minus $30 is 1,270. Yeah, you're right there. 11.70. Sorry, 11.70. Yes, it's me off 11.70, not the 11.90, because that includes the freight. But you have to add back the freight. Don't forget that. So, in this case, let's just determine how much we owe in general, because that's what the accounts payable is going to reflect. Okay, so here, if we have 1220 minus 30, that gives us 1190. Okay, that's how much we owe right now, is 1190. However, when we're taking our discount, it's going to be off of the 1170, because 20 of those dollars are going to be the freight.
Right.
So what is 5% of 1170?
5850.
5850. Okay. So then what is the total amount of the check that I'm going to write?
1131.50.
Hold on. Okay. What was that? 11.
31.50.
Yes, correct. So here, I'm going to go ahead and write here that I paid for purchases on 420. And then you're also going to say that you got a 5% discount and you paid with check number 3. Okay? Good. Right? And then last but not least, we have our last section here where we made we're going to pay for our last portion here. So in this case, on April 25th, we made a purchase of 500 units at $625 with the freight costing you $50. Terms are 5%, 10/30. So for sure, we definitely met the terms, right? This is only 5 days later. You're paying all 4 bills in one day. So in this case, we do get a discount. So how am I going to recognize this transaction here?
Accounts payable.
You're going to recognize accounts payable. Good. Because you're paying off what you owe. Okay. What else are you going to recognize?
Inventory.
Yes, because you're not paying for the full amount. You're paying less for the inventory. And lastly, you're going to recognize your checking because you wrote a check. Now, again, we're going to go back up to see how much on the 25th. If my purchases was for $31.75, how much is my discount going to be?
$158.75.
Try again. You'd include the freight. Yes, so I got that correct. Dan, you got that correct. 156.25. So therefore, my total payment is going to be
$301.5.
3018.75.
301875.
Yep.
Okay, good. So again, I'm going to also write here that I paid for purchases on 425, comma 5% discount, and I paid with check number 4. Okay, so again, this one is a little more trickier because you just have to remember that your accounts payable is going to reflect both your original purchase price and your freight expense. You just have to remember you cannot discount off of freight, you cannot discount off of sales tax, you can't discount anything because those are going to be considered separate costs. And the only thing that you can take a discount off is the original purchase price. But in this case, we got to take a look at what happens when you purchase something and return it. You also have to deal with how much is going to actually be reflected, but the freight is still going to remain the same. So in this case, good job, everybody. And that is it for chapters 7.1 through 7.3. That is perpetual inventory purchases, okay? Any questions in regards to this section? It's pretty straightforward.
You're gonna post this on the Google Drive.
Everything's going to be posted on there. Okay? All right. If you guys don't have any other questions tomorrow, we will go over